All right, let's get Jonathon Higgins. He is Shaw and Partners joining us for a bit more detail on the buy now, pay later space as we move further into 2021. Jonathon, last week, a lot of the talk was about that Affirm IPO in the US and how it contributed to some of the strength in the Afterpay share price. How do you see the line being drawn between the two?
Yeah, look, it's a great question. I mean, the Affirm IPO in the US has really put buy now, pay later on the map internationally, particularly with the funds over there and the size of the market that we're seeing internationally with a lot of the players going into there. So buy now, pay later was really an Australian phenomenon that's grown over the last 7 or 8 years. And it's only been recently in the last 3 to 4 that those businesses have started to go internationally. And we've seen the growth into those international markets. Interestingly, with Affirm's halfway between a credit card and a buy now, pay later in our view. Buy now, pay later is typically a high revolving, low cost rate for consumers that typically amortizes their products over anywhere from sort of 2 to 6 weeks. Whereas Affirm's more of your traditional credit tied type model, or halfway towards it, where they turn their book about twice a year. So with Affirm coming to market, it's actually now the most expensive buy now, pay later company in the world. It's now the largest buy now, pay later company in the world, probably excluding Klarna, which is an unlisted Northern European payments player that's also doing very well. But it's made Afterpay almost look cheap. Afterpay, in our view, is a significantly better business and significantly better business model. Yet I think it's trading at something like a 40% discount to what Affirm did at its IPO. With a vastly better capital structure. So it's really put it on the map, and it's made some of what we would consider to be nosebleed multiples for our leaders over here look almost cheap in comparison.
Jonathon, one thing I picked up on in recent weeks is that Afterpay has really outperformed compared to other rival buy now, pay later listings here in Australia. Do you say that a lot of the positivity, the fact that it looks cheap internationally and has a growing presence in the United States might be providing a few tailwinds for Afterpay?
Look, I think fundamentally you're right. I mean, buy now, pay later and Afterpay is probably the clear number one leader that's listed in the market in our view, even including Affirm. They've delivered multi-years of organic growth and 100% growth each year and obviously have a significant envelope both in Australia and also the US. I mean, if you look at Afterpay in the US, Afterpay has north of 13 million consumers in the US, and it's only been there for about 3 years. And Affirm has been in the US operating, I think, since about 2008, 2010 from memory, and they've only served 6.5 million customers to date. So if you're buying Afterpay and you're there as a global investor, you're really looking at the market leader. And so I think this has just shined a light on how Afterpay is looking. We by no means consider the companies in both the domestic exchange as well as the international exchange to be cheap by any measure of imagination versus Affirm or any of your other traditional multiples. What I would say with Afterpay is that it's probably had the most stratospheric increase of any company to go into major exchanges in Australia. So it hit the 200 very quickly, it hit the 100 very quickly, and then it hit the top 20, and it's now, I think, probably the 13th largest company by market capitalization in Australia on the exchange. So you've only got about 12 decent-sized tech companies in Australia that you can invest in, and Afterpay has been indexed a number of times, and I think we'll continue to see continued incremental buying as a number of funds, both domestically and internationally, stock up.
Okay, so if that is the future for Afterpay, still bright, still growing, still relatively cheap. Now we've had Affirm, I guess, setting the bar. What about the other buy now, pay laters that come in with different strategies, with different target markets? I'm thinking OpenPay, Lay-By, Split It, which is not quite buy now, pay later. I mean, what does the future hold for some of them? Will there necessarily be a consolidation?
Yeah, look, we think there will be a consolidation, but it's probably not in the near term. I think what you'll see is the bigger players getting bigger, and they'll be competitively in a very strong position internationally. And if you're not big, then you probably will fall by the wayside. We've seen the Zip Purchase Plan as an example close today. They're our second largest buy now, pay later company in Australia. That's closed today. They raised, I think, oversubscriptions of close to $30 million. They're a key pick here at Shaw and Partners. They're one of the largest businesses. So they've raised close to $150 million in the last 2 months, if you include the capital raise and the share purchase plan. That's a significant amount of capital to go after an international opportunity. Afterpay itself, as the 13th largest company, will have a significant amount of capital to both grow organically and inorganically. We haven't really seen these businesses look for inorganic growth trajectories at the moment. We're still seeing very low penetrations in the US, where you've got 3 to 4% of consumers with active accounts versus in Australia where you're at something like 25%. So it's probably a couple of years away. We don't think it's this year. We still think there's plenty of growth on offer for the whole sector not to be fighting each other at this point. And it's really only when they start to turn into a red ocean strategy in probably the next 24 months that we think we'll start to see consolidation with some of the smaller players getting snapped up. To put it into context, PayPal is one of the largest payments players in the world in the digital space. They've announced their own buy now, pay later option. We're uncertain of how that's going because they haven't released a lot of detail, but they're close to a $300 billion US company versus the three biggest in the world being Affirm, Klarna, and Afterpay, having close to probably a $100 million market cap between the three of them. So we still think it's a little while away. It will come. I don't think they're all fighting yet, but probably in about 24 months' time, we'll see a little bit of that starting to occur in our view.
Jonathon, let's talk about some of the risks that are still out there for the sector. One I want to go and touch upon is the stimulus impact that we've seen over the past 9 months or so. Everyone knows that people have been locked at home. Online sales have gone through the roof. A lot of the money being put through is from the government and it's temporary in nature. What happens when that gets pulled back? Is the growth trajectory that these companies are seeing at the moment likely to slow quite significantly, or can we go and see a familiar and similar rates in the future?
Yeah, it's a great question. I think there's probably two ways to split it. I think in the short term, it's a seasonally slow period for the sector, so it has to trade through that seasonally slow period. The Christmas period is obviously a large one, and the June period is typically also a large one that we're seeing both domestically and internationally. So I think in the short term, we'll see growth rates potentially slow a little on the back of the whole e-commerce phenomenon slowing potentially. And stimulus, you're correct. Stimulus has been a massive tailwind for the sector. I think it's been more on the credit front probably than from increasing origination rates. With buy now, pay later, it was growing strongly before the crisis. It's grown strongly into the crisis. And our view is it'll probably grow strongly after the crisis because we're not just looking at a difference in origination channels towards digital, but we're also seeing a multi-year shift away from card payments. Credit card payments is one thematic. We're seeing a shift away from cash is another thematic. And we don't even have things like offline options in international markets. So we think that towards the middle part of this year and the back end of this year, we'll continue to see those very strong growth rates. These players are all expanding into large markets, which should also support the growth trajectory. But in the short term, the sector probably will be going through a seasonally slower period, and it's always a more difficult period for investors to look at. But I mean, as evidenced by some of the retail results that we've seen out of companies today, it doesn't matter if you're offline or online, you're still seeing very strong growth. So that has been a tailwind. I think it probably just comes off a little bit.
Jonathon, just to go and wrap up, I saw you've got a note out today. Money3 has obviously gone and given an upgrade to its forecast, also announcing an acquisition of a bolt-on financial company. Where does Money3 sit in your? You like the stock?
Yeah, so we cover at Shaw and Partners. We cover Money3. Money3's been a long-term buy from ourselves. We continue to see that view playing out. Look, Money3 is one of those companies that's going to come out of COVID in a competitively stronger position than what it into. It has an extremely strong balance sheet and it's almost geared like an industrial company, and it's just opportunistically picking up a number of different assets that are going to push it up the credit quality curve. So Money3 is trading on about 11 times PE into FY22. A comparable business in Credit Corp, which we think has a similar returns profile to where we see Money3 over the next couple of years, is trading at about double the multiple. So there is potentially multi-years of growth ahead of Money3, both from market share and earnings point of view. We really do like the stock. FY22 should be a really strong year for the business, supported by some of the stimulus measures you're talking about, as well as automotives are a very strong recovery trade in the COVID period, as well as they've got a book refinancing that they've already announced that's coming through in June, which should add about 20% to the earnings profile of the business and could potentially see a re-rate. So Money3 is one of our core recommendations here at Shaw and Partners, and we continue to see further upside over the stock, both short to long term.
Okay, so just to recap, Afterpay, Zipco are buys as well as Money3.
Yeah, so we continue to have a favourable view on the buy now, pay later sector and e-commerce in general. We think some of the tailwinds are probably going to slow in this quarter and then see them strengthen at the back end of the year. We don't think that the digital payment players will have as much trouble comping as what the e-commerce players are, like your Redbubbles, Temple & Webster's, Kogan's. So that sector continues to remain a buy, and we see strong multi-year growth ahead. And also Money3, we continue to remain favourable on and have a buy recommendation of the stock and see multi-years of growth ahead of us.
All right, well, there will be many of our viewers out there. You've hit the nail on the head with a lot of the most followed companies here on the Ausbiz platforms. We really appreciate your insights. Thanks, Jonathon.
Thanks very much.